you want to grow your money with ease and confidence? Welcome to a journey that's all about financial growth and security. We live in a world where relying solely on one income stream can leave us vulnerable. What if we could build multiple streams of income, like investments or passive income? Imagine the financial security that could bring. Imagine the freedom to pursue your passions without the constant worry of money. In this video, we're going to introduce you to the concept of growing your money and why it's so important for achieving financial security and freedom. We'll walk you through a step-by-step beginner guide that will enable you to nurture your finances with confidence. From understanding investments to the importance of financial education, you'll learn how to start small, manage risks and rewards, and diversify your investment portfolio. So, are you ready? Step into the world of investments and passive income and see your money grow. Investment, a word that might seem daunting at first, but it's simpler than you think. Let's imagine you've got a seed. This seed represents your money. Now, you could just hold on to that seed, but then it's just a seed, right? However, if you plant that seed in fertile soil, give it water, sunlight, and time, it will grow into a tree that yields fruit year after year. That's essentially what investing is. Investing is the act of putting your seed, your money, into financial schemes, shares, or property, with the expectation that it will grow over time. Instead of just holding on to your money, you're using it to generate more. You're giving your money the chance to multiply and bring you a return on your investment. But how does this happen? It's all about the power of compound interest, my friends. When you invest your money, it earns interest. Then that interest earns interest, and so on. This is compounding. For example, let's say you invest $1,000 at a 10% annual return. After the first year, you'll have $1,100. That extra 100 is your interest. If you leave it all invested, the next year you'll earn interest on the full $1,100, not just the original $1,000. It's like a snowball rolling down a hill, gathering more snow and getting bigger as it goes. Your money does the same thing when you invest. It grows, and the more it grows, the faster it grows. Investing is not just for the wealthy or financial experts. It's for everyone. Whether you're starting with a little or a lot, investing can help you grow your wealth over time. But remember, investing comes with its share of risks. Not all investments will yield the expected profits, and some might even lead to losses. However, with knowledge, patience, and a well-diversified portfolio, you can navigate these risks and grow your wealth. Investing is not about getting rich overnight, it's about growing your wealth over time. It's about planting that seed, tending to it, and watching it flourish into a fruit-bearing tree. So, are you ready to plant your seed? Now, you might be wondering, what can I invest in? A good question. There's a wide world of investment opportunities out there, but let's start with the basics. First off, stocks. When you purchase a stock, you're buying a piece of a company. You're essentially becoming a part owner of that business, however small your share may be. As the company performs well and its value increases, so does the value of your stock. But remember, the opposite is also true. If the company struggles, your stock may decrease in value. Next up, bonds. Bonds are essentially loans you give to an organization, usually a corporation or government. In return for your loan, the organization promises to pay you back the original amount, plus interest, after a set period of time. Bonds are often seen as less risky than stocks, but the potential returns are also usually lower. Then we have mutual funds. A mutual fund is a pool of funds collected from many investors, managed by a professional fund manager. The manager uses this pool of money to buy a diverse range of assets, like stocks and bonds. This gives you the chance to own a small piece of a large, diverse portfolio. Lastly, real estate. This is probably the most tangible type of investment. You can buy properties to rent out, or you can buy and sell properties for a profit. Real estate can be a great way to generate income, but it's also a big commitment, both in terms of time and money. These are just the basics. There are many other types of investments out there, like commodities, exchange-traded funds, and even digital assets like cryptocurrencies. Each type of investment carries its own risks and rewards, and it's important to understand these before you dive in. There are many ways to invest your money. Choose the one that fits your financial goals and risk tolerance. And remember, investing is not about getting rich quick. It's about growing your wealth steadily over time. Get to know the different types of investments, do your homework, and make informed decisions. Your future self will thank you. You don't need a fortune to start investing. Let's dispel a common misconception right off the bat. Investing isn't just the playground for the rich. Quite the contrary, it's an opportunity for everyone to build wealth over time, no matter how big or small your initial capital might be. Starting small with investments is not just a viable approach, it's a smart one. It's about taking that first step, however small, on the journey towards financial independence. You might think that a few dollars here and there won't make a difference, but think about the concept of compound interest. It's the snowball effect of your investments, where the returns you earn are reinvested and start earning returns of their own. Over time, even the smallest amounts can grow into a substantial nest egg. Consider this. Let's say you start by investing just $10 a week. It might not seem like much, but over the course of a year, you've invested $520. If you continue this for 10 years, with an average annual return of 7%, you would have over $8,000. Now, what if you were able to increase that to $20 a week or even $50? The potential for growth is substantial. There are plenty of investment options available that allow you to start with small amounts. Micro-investing apps, for instance, enable you to invest your spare change. Then there are low-cost index funds that offer a diversified portfolio for minimal entry costs. There's no shortage of opportunities to start your investment journey, no matter your financial situation. Starting small also allows you to learn the ropes of investing without putting too much at stake. You get to understand how markets work, how to analyze trends, and how to make informed decisions. It's a learning experience that can prove invaluable as you progress in your investment journey. Remember, the journey of 1,000 miles begins with a single step. So take that step, however small, and start your journey towards financial independence today. It's not about how much you start with, it's about starting. With investments, there's always a balance between risk and reward. This principle is as fundamental as the law of gravity in the world of finance. It's the yin and yang that keeps the investment universe in harmony. Imagine you're at a crossroad. On one side, there's a well-trodden path that promises safety and a modest reward. On the other side, there's a less traveled path that's fraught with uncertainty. But the potential rewards are much larger. That, in essence, is the choice you face when you decide to invest. High-risk investments like startup businesses or volatile stocks can potentially offer higher returns. However, they also come with the risk of losing a significant portion, if not all, of your initial investment. These are the less traveled paths, where the potential for reward is rivaled by the potential for loss. On the other hand, lower risk investments, such as government bonds or savings accounts, offer smaller yet more predictable returns. These are the well-trodden paths, where you trade the prospect of high returns for the comfort of stability. Now, it's worth noting that risk isn't inherently bad. In fact, risk is what fuels the potential for reward. It's the engine that drives the investment vehicle. But not everyone is comfortable riding in a high-speed car. Some prefer a leisurely drive in a slower, more predictable vehicle. That's where the concept of risk tolerance comes into play. Risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. It's a deeply personal thing, influenced by factors such as your financial situation, your investment goals, and even your personality. So, how do you determine your risk tolerance? It involves honest self-reflection and perhaps consultation with a financial advisor. It's about understanding your financial goals, your time horizons, and your emotional comfort with potential losses. In conclusion, risk and reward are two sides of the same coin in the world of investments. They're inseparable, and balancing them is key to successful investing. It's important to evaluate your risk tolerance before making any investment decision. Don't put all your eggs in one basket. You've probably heard this saying before, and when it comes to investing, this wisdom holds especially true. This idea is what we call diversification. Diversification is a strategy that involves spreading your investments across a variety of assets. This can include different industries, geographic regions, or types of securities, like stocks, bonds, or real estate. The goal is to reduce risk by not relying too heavily on any single investment. Imagine a scenario where you've invested all your savings into a single company's stock. If that company performs poorly, you could lose a large portion or even all of your investment. But if you spread your investments across different companies and industries, the poor performance of one investment may be offset by the strong performance of others. Think of it like a safety net. If one part of the net fails, the rest of the net can still hold. Diversification doesn't guarantee you won't lose money, but it can help to limit your losses and smooth out the ups and downs of your investment returns over time. It's also important to remember that diversification isn't about simply owning a lot of different investments. It's about owning the right mix of investments that align with your financial goals and risk tolerance. For instance, if you're a conservative investor, you might have a larger portion of your portfolio in safer, more stable investments like bonds or cash. If you're more aggressive, you might lean more towards stocks or real estate. Diversification also isn't a set it and forget it strategy. As market conditions change, you might need to adjust your portfolio to maintain the right balance. This could mean selling some investments and buying others, or simply rebalancing your portfolio to its original mix. In conclusion, diversification is a powerful tool that can help you manage risk and achieve more consistent returns. It's like a seatbelt for your investment journey. It won't prevent a crash, but it can help to lessen the impact. Diversification can help you achieve a balance between risk and reward. Knowledge is power, especially when it comes to growing your money. In a world where financial security is becoming increasingly pivotal, understanding the dynamics of money is crucial. It's not always about how much you earn, but how well you manage and grow what you have. Financial literacy is the compass that guides this journey, illuminating the path towards prosperity. Why is financial education so important, you ask? Well, it's the cornerstone of wealth creation. It empowers you to understand how money works and how it can work for you. It equips you with tools to navigate the complex landscape of investments, savings, taxes, and debts. Imagine being in a foreign country without understanding the local language. It's confusing, right? You might get lost or make poor choices simply because you can't comprehend your surroundings. The world of finance can be just as bewildering without proper knowledge. But with financial literacy, you get a map and a translator, enabling you to make informed decisions and avoid costly mistakes. Financial education is not just about learning the terms and concepts. It's about understanding the underlying principles that govern money. It's about recognizing the value of $1 today versus $1 tomorrow. It's about grasping the concept of compound interest, often referred to as the eighth wonder of the world. Moreover, it's about building the confidence to step out of your comfort zone and explore opportunities that can amplify your wealth. It's about knowing when to take risks and when to play it safe. Financial education gives you the power to control your money, rather than letting your money control you. In conclusion, financial education is the key that unlocks the door to financial freedom. It's not an overnight process. It's a lifelong journey of learning, adapting, and growing. So remember, every bit of knowledge you gain is another step towards a secure and prosperous future. Invest in your financial education. It's the best investment you can make. Growing your money is not a sprint, it's a marathon. A powerful sentiment, one that captures the essence of what we've been discussing. Like a marathon, the journey of financial growth requires preparation, stamina, and perseverance. But most importantly, it requires a well-thought-out plan. Let's quickly revisit our key takeaways. We've understood that investments are not just about stashing away money and hoping for the best. Rather, it's about making informed decisions based on knowledge and understanding of various investment options. Whether it's stocks, bonds, real estate, or starting a side business, each investment type comes with its own set of risks and rewards. We've learned that it's perfectly okay to start small. In fact, it's encouraged. No one becomes a millionaire overnight. It's the small, consistent steps that lead to significant financial growth over time. Remember, it's the habit of investing that's more important than the amount invested. We've also highlighted the importance of diversification. Putting all your eggs in one basket can be risky, By spreading your investments across different types, you can better manage risk and increase your chances of steady returns. Lastly, we've underscored the crucial role of financial education. Staying informed and continuously learning about the financial world can help you make smarter investment decisions. It can empower you to take control of your financial future and navigate the ups and downs of the investment landscape with confidence. Now, it's time to put these learnings into action. A word of caution though, patience is key. There will be good days and bad days. There will be victories and setbacks. But remember, it's a marathon, not a sprint. It's the long game that counts. So, equip yourself with knowledge, discipline, and resilience. Take calculated risks, learn from your mistakes, and stay committed to your financial goals. The journey may be long and sometimes challenging, but the rewards are well worth the effort. Start your investment journey today and watch your money grow with